Okay, let's dive into this explainer. Think about looking at a massive, complex, multinational corporation. Trying to figure out where they actually make their money? Yeah, it can totally feel like staring into a black box. Is it the phones driving revenue, software, cloud storage, or, I don't know, a secret electric car division? Well, IFRS 8 is the tool designed to literally pry that box open. It dictates exactly how publicly traded entities have to break down their massive businesses into smaller, digestible, public pieces. We've got a solid agenda today. We're going to hit the core principle, define operating segments, look at how we identify reportable segments, go over the required segment disclosures, and wrap up with entity-wide information.
Section 1, the core price pool.
So to start our journey, filtering down from the big picture philosophy right into the nitty-gritty data, we have to look at the foundational idea driving this whole standard. The absolute crucial point here is that IFRS 8 is ultimately about empowering the user of the financial statements to truly understand how the business makes its money, right? It's not just dumping data for the sake of data. It's all about context. If you're an analyst, you need to evaluate the specific business activities and the distinct economic environments a company operates in. Because let's face it, a dollar earned in a risky high-tech startup division has a wildly different risk profile than a dollar earned in a legacy manufacturing plant. This principle is basically our North Star for everything else we're about to cover.
Moving to Section 2, defining operating segments.
Before a company can report anything to the public, they need to figure out how the business actually organizes itself behind closed doors. An internal operating segment is basically born when it passes 3 specific criteria. First, it has to engage in business activities where it might earn revenues and incur expenses. And honestly, this is interesting. It even includes startup operations that haven't earned a single dime yet. Second, its operating results have to be regularly reviewed by a key internal figure called the CODM, who decides how to allocate resources and assess performance. And third, discrete financial information must actually be available for it. But keep in mind, not every part of an entity makes the cut. Things like corporate headquarters or post-employment benefit plans, they're explicitly left out because they just aren't revenue-generating operating segments.
Now, the CODM. It sounds like a highly classified secret agent, right? But the standard actually cares about the function, not the fancy nameplate on the door. It stands for Chief Operating Decision Maker. This could be a CEO, a COO, or even a whole group of directors. It's just about identifying whoever is actually steering the ship day to day. The standard uses what we call the management approach. Basically, the financial information you see from the outside should closely mirror exactly what the CODM is looking at on the inside.
Section 3, identifying reportable segments. Let's see how this builds because, spoiler alert, not every internal operating segment actually makes it into the final public report. We have to filter our internal segments through some strict mathematical tests to see which ones graduate to become external reportable segments. Just because the CFOM reviews a division internally doesn't automatically mean it's significant enough for a detailed public disclosure. I mean, if a company has 50 tiny operating segments, reporting all of them would just be overwhelming and, honestly, pretty useless. So, since accountants love their thresholds, IFRS 8 sets up some specific quantitative limits. The first test is all about revenue. If a segment's reported revenue, and we're talking both external sales and internal transfers between segments, is 10% or more of the combined revenue of all operating segments, boom, it automatically must be reported separately. It's just a really straightforward size test based on the top line. But what if a segment doesn't have massive revenue, but it's incredibly profitable? Or maybe bleeding cash and taking massive losses? That brings us to the second test, profit or loss. A segment makes the cut if the absolute amount of its profit or loss is 10% or more of the greater combined profit of all profitable segments, or the combined loss of all losing segments. We use absolute amounts here because, let's be real, a massive loss is just as economically significant to an investor as a massive profit. The third test looks at assets. If a segment is holding on to 10% or more of the combined assets of all operating segments, its secrets are getting revealed to the public. Even if a segment isn't generating huge revenues or profits right now, if it's tying up a full tenth of the company's total resources, users of the financial statements absolutely have a right to know what's going on in there. So hitting just one of these 3 10% thresholds, revenue, profit or loss, or assets, promotes an operating segment into a reportable segment. But wait, there is a dramatic overarching rule here. If the total external revenue of your reportable segments is less than 75% of the entity's total revenue, you actually have to identify additional segments until you hit that 75% mark. You can't just have a few large segments and then hide half your business in some generic other bucket. The standard forces transparency, making sure the vast majority of the company's revenue is clearly categorized and explained, even if management has to dip way below those 10% thresholds to get there. Now, what if a company has a dozen tiny segments that all basically do the exact same thing? Well, if segments share similar long-term financial performance and economic characteristics, management is allowed to aggregate them. But they need to be really similar, like in the nature of their products, production processes, customer types, distribution methods, and regulatory environments. Think of grouping 3 different regional clothing brands into one unified retail apparel segment, as long as they check those boxes. Anything that doesn't meet the 10% tests and doesn't get aggregated just gets tossed into an all other segments category at the end.
Section 4. Required segment disclosures.
So, now that we know exactly which segments survived the funnel, let's look at the actual disclosure checklist. This is where the transparency really kicks into high gear. First up, general info. The entity has to explain exactly how it identified these segments and describe the products and services they offer. Then we bring in the heavy hitters, a measure of profit or loss, total assets, and total liabilities. But it goes even deeper than that. If the CODM regularly reviews specific items like interest revenue, interest expense, depreciation, amortization, or income tax expense for a segment, well, those specific line items must also be disclosed to the public. It makes sure external users get to see the business through the exact same financial lens that management uses. Because segment information is built on internal management reporting, it actually might use totally different accounting policies than the formal public financial statements. Because of that, everything must tie perfectly back together. The entity is literally required to reconcile all these segment totals directly back to the entity's overall financial statements. You have to bridge that gap. Say a segment's profit is calculated differently than the consolidated profit before tax, the company must provide a crystal clear reconciliation explaining every single material adjustment. It's brilliant because it keeps the internal reporting honest and anchored firmly to the overall consolidated reality. Section 5. Entity-wide information. We have reached the very tip of our funnel, looking at rules that apply to all entities. Yes, even those with only a single reportable segment. Sometimes a company's internal structure, how the CODM reviews things, doesn't naturally break down by product or geography. But that information is still totally vital to investors. So unless the cost to develop the info is completely excessive, the entity must report revenues by product and geographic area to give users a full picture. You've got to disclose revenues from external customers attributed to your home country and all foreign countries in total. And if a specific foreign country is material, it gets its own separate disclosure. Same goes for non-current assets. It essentially prevents a massive single-segment giant from completely hiding its geographic risk. And here is a really fascinating requirement all about vulnerability. You don't have to explicitly name a major customer, but you absolutely must disclose your reliance on them and specify which segment is reporting those revenues. Listen, if one single customer provides 10% or more of your entire company's revenue, that is a massive concentration of risk. Investors desperately need to know if losing a single contract could just instantly wipe out a tenth of your top line. Which brings us full circle, right back to the core principle. As you apply the strict lenses of IFRS 8 to your organization, ask yourself, do your disclosures truly give users the clarity they need to understand your operations? Are you just checking boxes and meeting minimum mathematical thresholds? Or are you actually providing a transparent, internally consistent view of your risks, your major customers, and your geographical footprint? Because at the end of the day, the numbers on the page are only as good as the story they accurately tell. Think about that as you dive into your next set of financial statements.